Welcome to Essential Working Capital and Liquidity Ratios, your comprehensive guide to understanding and enhancing financial health and stability. In today's dynamic economic landscape, whether you're managing personal finances, growing a small business, or navigating a large corporation, a firm grasp of these fundamental ratios is absolutely critical. They serve as vital indicators, offering deep insights into an entity's immediate financial standing and its ability to meet short-term obligations. This presentation will demystify working capital and key liquidity ratios, equipping you with the knowledge to not just react to financial situations, but to proactively plan and make informed decisions that ensure long-term stability and growth. Let's dive in and unlock the secrets to financial mastery. Let's begin with working capital. Simply put, working capital is the difference between your current assets and your current liabilities. Think of it as the readily available capital you have to run your day-to-day operations and cover your short-term obligations. Current assets include cash, accounts receivable, and inventory, items you expect to convert to cash within a year. Current liabilities are obligations due within a year, such as accounts payable, short-term loans, and accrued expenses. A positive working capital indicates that you have enough liquid assets to cover your short-term debts, signifying a healthy operational flow. Conversely, negative working capital can signal potential liquidity problems, making it harder to meet immediate expenses and grow. Now, let's turn our attention to liquidity ratios, starting with the current ratio. This is one of the most widely used metrics for assessing short-term solvency. The current ratio is calculated by dividing your current assets by your current liabilities. It tells you how many times your current assets can cover your current liabilities. A higher ratio typically indicates a stronger ability to pay off short-term debts. While the ideal ratio can vary by industry, a benchmark, 2-to-1, often healthy, is a commonly cited guideline. This means having twice as many current assets as current liabilities. A ratio below 1-to-1 suggests you might not have enough assets to cover your immediate debts, while an excessively high ratio might indicate inefficient use of assets. While the current ratio provides a good general overview, the quick ratio, also known as the acid test ratio, offers a stricter assessment of immediate liquidity. This ratio is more conservative because it subtracts inventory from current assets before dividing by current liabilities. The formula is current assets minus inventory divided by current liabilities. The rationale behind excluding inventory is that it's not always easily convertible to cash, especially for businesses with specialized or slow-moving stock. Therefore, the quick ratio provides a clearer picture of a company's ability to meet its short-term obligations without relying on selling its inventory. An ideal 1-to-1 or higher is generally considered healthy, indicating that a company has sufficient highly liquid assets to cover its immediate debts. For the most conservative and stringent view of liquidity, we look at the cash ratio. This ratio focuses solely on a company's absolute most liquid assets, cash and marketable securities. The formula is cash plus marketable securities divided by current liabilities. Marketable securities are investments that can be quickly converted to cash. By only including these highly liquid assets, the cash ratio provides the purest indication of a company's immediate solvency, or its ability to pay off all its short-term liabilities immediately without selling inventory or collecting receivables. While a high cash ratio might seem ideal, it can also suggest that a company is holding too much cash, which could be better utilized for growth or investments. It's an indicator focused purely on immediate solvency. Understanding these ratios goes far beyond mere calculations. It's about gaining critical insights into the very heart of financial health. For one, strong working capital and liquidity ratios are key to attract investors and lenders. They signal stability and lower risk, making your business more appealing for funding. Internally, these ratios help you identify financial weaknesses before they escalate, perhaps an inventory buildup or delayed receivables. They guide strategic decisions, informing everything from pricing and procurement to investment and expansion plans. Ultimately, proactive management of these ratios helps ensure business stability and growth, safeguarding against unforeseen challenges and paving the way for sustainable success. They are truly the bedrock of robust financial planning. So, how do you actively use these ratios for success? First, it's crucial to monitor trends over time. Don't just look at a single snapshot. Track your ratios monthly or quarterly to spot improvements or deteriorations. Second, compare to industry benchmarks to see how you stack up against competitors and identify areas for improvement. When it comes to improving your ratios, consider strategies like optimize inventory to free up cash or manage payables effectively by negotiating better terms. Proactive financial management isn't just about reacting to problems. It's about continuously seeking ways to strengthen your financial position, ensuring you're always prepared and poised for growth. This is where real financial power lies. In conclusion, understanding working capital and liquidity ratios is not merely an academic exercise. It's a fundamental aspect of financial literacy and strategic business management. Remember, working capital is vital for your daily operations, while the current ratio provides your first liquidity check. The quick ratio offers a stricter assessment, and the cash ratio gives you the safest view of immediate solvency. By regularly monitoring and actively managing these indicators, you can gain invaluable insights into your financial health, anticipate challenges, and make informed decisions that lead to sustainable growth and stability. Embrace these tools, and you'll be well on your path to financial mastery, truly empowered to shape your financial future.